This is Alan Farley from FX Empire. FedEx reports earnings after Thursday's closing bell. Looking back, the stock topped out around 275 in January 2018, at the same time that President Trump fired the first shot in the trade war with China. Now, this rather modest pullback accelerated after Amazon.com reported that it was going to start its own fleet of in-house delivery, taking business away from UPS and FedEx. Stock continued to drift lower, and then the bottom dropped out during the pandemic. The stock dropped to a 7-year low down in the 80s, reversed gears and started to improve. Then Amazon reversed gear and said they weren't going to start their own in-house delivery service. Well, the stock took off, recovering all the way back to the prior high in October. Now, this is sort of when the trouble started, because we did get right here a breakout into October, and that failed. And we got another breakout in December. That failed. Pulled back in this nice little rounded pattern, which should have given us sort of a cup with a high handle pattern or an inverse head and shoulders pattern. And it broke out in April. But then it reversed once again in May, and it's broken this little trend line that goes back to February. Now, this is a weekly chart. This is kind of bad news. We're still accelerating to the downside heading into earnings. That's not particularly bullish. And we could find our way all the way down to the 50-week moving average right down here. Unfortunately, that level is also below the 2018 high. So if you've been a long-term shareholder, you've really got nothing out of FedEx in what, 1, 2, 3, 3.5 years. So shareholders are getting frustrated. It is showing up in the distribution numbers and on-balance volume. And this is a very critical report for FedEx, especially after United Parcel Service earlier this month posted very modest financial targets through 2023.